Welcome to myFXplan. Today's topic with myself, Craig Merchant, is covering moving averages. The following session is not to be treated as personal advice. myFXplan provides general advice only that does not take into account your personal objectives, financial situation, or needs. Trading FX and CFDs involves a substantial degree of risk and should only be undertaken with risk capital. Investors do not own or have rights to underlying assets. What is a moving average? One of the most commonly used indicators in technical analysis, a moving average calculates the median of the past data points and represents this information as a line to filter out market noise. Moving averages smooth the price action to form a trend following indicator. They do not predict the price direction, but rather define the current direction with a lag. The two most widely used types of moving average are the simple moving average, which is a simple average of the previous sessions, and the exponential moving average, which gives more weight to recent sessions. Moving averages can be used to identify trend and entry points. Many traders use two or more moving averages to set up what are called trigger trades on short-term trends. The trigger is pulled when the more volatile moving average, which is the lower number, crosses over the less volatile moving average, which is the higher number, as confirmed by the most recent candle close. The trade is closed when the lines recross in the other direction. Here is an example using the 21 and 8 moving averages on NZD JPY. Notes on the previous example used using the 21 and 8 moving average. Trade is with the trend. Wait for the present period to close before measuring wherever a crossover has occurred. Enter on the open of a period following the crossover. Exit when observing a change of direction. If an entry is missed or the price moves too quickly, wait for a rotation back to the 21 moving average. In this example, the blue line. Moving averages tend to be magnets for price action. Price will tend to be drawn towards or attracted to MAs, and when touched, it will often become repelled from them. Moving average 50, 100 and 200 strategy. Often a higher moving average can be used as a filter to determine the longer term trend. Use the moving average to identify prevailing momentum, and longer term moving averages 50, 100 and 200 react more slowly to price changes and therefore measure long term trends. The following example shows 50, 100 and 200 moving averages on a daily chart to identify the trend and the value zones for entry. Here's an example from earlier today on AUD NZD. Notes on the previous moving average example where we used the 50, 100 and 200. The value zone is a high probability price area where the smart money is looking to trade against the short-term trend but with the long-term trend. This is demonstrated in the above example by the price between the 100 and 200 moving averages. Now wait for the move in the value zone and then trade on a recross. The recross occurs when the price closes for the first time above the 100 exponential moving average for longs or buys, and below for the 100 exponential moving averages for shorts or sells. Now, any further questions you may have on these two examples, please do email myself on the displayed email on your screen, and I will get back to you as soon as I can. Take the next step to financial freedom. Now, today's presentation is also attached with the two templates we just previously looked at in both examples of the 21 and 8 moving average and the 50, 100 and 200 moving average. Now, that will be all today. Thank you and goodbye.